Hello and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal, it's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, founder and CEO of Deal Room and chief scientist here at M&A Science. Today's guest is Harrison Thomas, chief growth officer at Beacon Specialized Living Services. Harrison leads growth in M&A in one of the most operationally complex corners of healthcare, home and community-based services, from acquiring unsophisticated mom-and-pop providers to navigating high-touch integrations across fragmented state systems. Harrison brings a nuanced, boots-on-the-ground perspective on what it really takes to scale in this sector. In this interview, we're going to talk about the unique challenges of M&A in a highly regulated, Medicaid-funded healthcare service and learn how to approach due diligence in mom-and-pop businesses with hidden liabilities. Harrison, how you doing today?
Doing great, Kisan. Thanks for having me.
Thanks for hosting at your office here just outside of Nashville.
Welcome to Middle Tennessee. It's a pretty day. It's going to rain for the next 4 days, so I'm glad you're here today.
It's been a beautiful day, so I'm glad that worked out.
Yep.
Can we kick things off a little bit about your background?
Yeah, so I'm Chief Growth Officer at Beacon. I've been here at the organization for a little over 8 years now. I originally started in healthcare. Nashville is the healthcare capital. A lot of people don't realize that. We have some of the largest health systems in the country based out of here. And thus, everybody that makes money knows how to spend their money in healthcare, and that's one place they do it. I came in, started working for a large publicly traded company here in Nashville, doing corporate development for a number of years, learned a lot on the finance side, as well as just kind of the strategic partnerships. Company was actually one going through activist investors, so learned a lot about how do you navigate a little bit of pressure from the external capital space. So that was how I started in healthcare, ended up getting into behavioral health, getting into technology, had a real estate degree from college, so a lot of different experience, and that all kind of culminated in Beacon Specialized Living. So I was approached by Darren Hodgson, the CEO at Beacon, and Darren and I had overlap at one of my companies. And from there, started looking what Beacon did and really got excited about the mission of the company and where we were going.
It's a pretty broad deal experience, kind of been at the helm of the corporate world, and now you're on this platform. Can you talk me through what Beacon's M&A strategy looks like, how you've seen it evolve over the 8 years you've been here?
Yeah, so Beacon is a home community-based service provider. So that means we're in the Medicaid reimbursed space, serving individuals with developmental disabilities and severe mental health needs. And so we, as a niche, support some of the most challenging behaviors of individuals anywhere in the country. And because of that, we started in Southwest Michigan. I actually moved my wife to Michigan. She was 34 weeks pregnant, last day she could travel. And when we started up there, we had about 200 employees. Now we're a little over 3,000 employees.
Wow.
And starting from where we were to where we are, it was really about taking what was a very underserved population. We've kind of taken the mantra and the founder of the business that we will be the provider of choice when there are not other providers that are willing to take on the needs of the individuals to be served. Because we take that mantra, we were really able to kind of step in and look at different market segments, not just where we started in Michigan, but in the other 8 states we've entered, and been able to focus on that very specific niche of people with challenging behaviors. And so from an M&A perspective, we're a little different. We're not a roll-up shop. We're very focused on finding the right type of quality provider, someone that aligns with what we like to think we do in the existing markets that we're in, but that also has a culture of care and compassion and dignity for the individual served, and then saying, hey, what does it look like if we overlay our capital structure, our infrastructure, the supports in the back office, and the additional clinical and medical team that we have that most mom and pop providers don't have, And then how do we then accelerate growth and find more people to be served? So our M&A focus has really been that, to find those type of providers.
So you've seen the growth from 200 to 3,000 employees operating in one state, now in 8 different states. Big focus on operational efficiency and optimizing revenue.
Yeah, absolutely. Actually, when I started at Beacon, my role, I've had the title of Chief Growth Officer the whole time, but I was the CFO, I was in charge of IT, I was in charge of facilities. So for a number of years, I had the full gamut of experience, which has been great from an M&A perspective, because I've really gotten to look at how do these businesses operate? What are the key value drivers? What are the financial metrics that matter? And frankly, in the human capital space, human services space, there's very simple metrics that you pay attention to. What is the labor as a cost of the revenue? What are the staffing ratios that you use to support? A lot of these financial and kind of KPI metrics are simple to focus on. And having the lens of the finance chief, I was really able to say, this is what you have to do to make a viable business, but also what are the, frankly, dyssynergies that we're going to end up overlaying, because we're a much more sophisticated organization with a lot more comprehensive back office.
So you built the template to evaluate these deals, but then you also got an understanding of dyssynergies too, which I think is things you learn over time.
Absolutely. Yeah. That's when we talk about our PTO policy, our health benefits, all of the support structure that we have, the technology we're bringing to the table, those other providers don't have that. So we're usually walking them back.
How many deals have you done in the years?
Here at Beacon, we've probably gone through around 15, 16 deals in the last 7, 8 years.
It's a good number.
That we've closed. I think the humor of this is, and we can actually talk about how we've leveraged the CRM with Dealroom, because we did a major pipeline cleanup, and we need we're closing maybe 2 to 3% of the deals that really enter the front end of the pipeline, and that we engage in some form of diligence. And there's just so many factors where they fall out in the deal flow. So it's, that 15, 16 deals that we've closed, there's a lot on the front end to be able to get down to that number.
Well, we'll talk about that. And this adds a disclaimer. You are a Dealroom customer. We aren't going to make this into a big commercial pitch for Dealroom, but I'm renting out. Like, we have 200 customers, so it's hard to avoid corp dev folks that aren't using the platform. So that's the early days when we started doing this, it was easy. Nobody knew about it. So if we look at these deals, the 15, 16 deals, one of the things you mentioned to me is about 80% of your pipeline consists of deals that are sub 600K EBITDA. What makes like the size sort of viable or not viable? Because there's like pros and cons, I guess, going bigger versus smaller.
Yeah. So our space is a niche that I didn't even know about in healthcare. Home and community-based services, the very nature of what the providers that are in our space do is a lot of times 24/7 care for individuals with these challenging needs. Thus, most of those organizations really are founded out of kind of a mom and pop structure. It's a lot of times it's caregivers that say, well, someone asks them to open a second home or a third home. Or it's someone that's coming out of nursing or some other background. It's very rare that we would have a business, someone coming in with an MBA that starts a business in this space. That's unusual. And so what we see is those providers really scale to the point at which their capacity of their ability to touch the people they're supporting taps out. Building a back office, building training and recruiting and clinical and all the accounting functions and HR functions. It's not what they do. They're caregivers. They just want to support people. And so because of that, we almost see these thresholds of EBITDA and earnings that they reach that they don't really surpass. And that threshold of that 600, a lot of those mom and pops can get up to that. It's that small business owner, but they've not invested in the additional infrastructure that goes beyond their ability to actually go support the home. Because very often we find out that the owners are the people going and filling the midnight shift when somebody calls off and there's no one to actually support. And so that's where it gets really complex, because these smaller deals, one, they don't have clean books. Every time we go through the numbers, it's the hardest exercise is actually trying to scrub the financials. No one's doing things on an accrual basis. It's all cash. So when we start talking to them about, hey, the run rate looks like this, what is run rate? What does that mean? It's like, well, if we actually scrub the timing of your inflows and outflows, this is what it's going to look like. So we spend a lot of time hand-holding these providers to try to help them understand their own business from a financial perspective or from a KPI perspective. Maybe even if they're doing a $500,000 business, there may only be serving a dozen people. Well, if two of those individuals leave and the census changes, the business has fundamentally changed. So we have to go into depth with them and explain, hey, this is where the business is trending compared to where you think it's at.
Do you just get that trust, or is it earned?
That is very much the complex part of my job. I think a robot could replace all the diligence that I do, but it's the empathy, it's the emotional intelligence to actually engage with people, to try to understand where they're coming from. I spend a lot of time. I've got a kid that came over and is working with me, came from our capital partner side. He's way smarter than I am. But I told him, I said, this is the thing you've got to learn. You've got to learn how to interact with people. You got to learn how to win the trust. You got to learn how to win the business. And it's very much a transparency game. And so I kind of open the kimono and let everybody understand exactly where we're coming from, exactly what we're seeing up front, and tell them where we're going to run into issues before we ever get to them, so that it doesn't blow up the deal further down the road.
Give me an example. Like if you were to tell them, like, hey, these are the issues that I could foresee happening. Like what are examples of that?
Yeah, so there's a lot of different stuff. When they start unpacking how they run their business, right? They might have, oh, this is our staffing, or we've got two different operating companies. And so we've had a lot of companies who they create multiple operating companies and have people working under each umbrella, but they're not paying them overtime because those individuals are working 40 hours here and 40 hours there. Well, Department of Labor doesn't view that as someone not earning overtime. And so we have to make them aware of that. Or we'll see that their billing practices, they're not doing the reconciliations that are the way they're required at the state level. And so we have to get involved and unpack with them why that's not right. And so a lot of times I'll bring in a third party, because it's a sensitive line to say, are we just trying to push down the numbers? Are we trying to negotiate with them? And I try to make sure, like, look, this is not me negotiating with you right now. This is me trying to open up and make sure you understand what's actually happening here and whether or not that meets labor laws, billing laws, regulatory laws, and why that's something we have to account for in the way we build the structure. And that's where we spend a lot of time in the handholding.
Firm Room, the world's most intuitive virtual data room, now with AI contract analysis. All right, at this point, I feel like everything in the world has AI in it. But let's talk about something important. Have you or your M&A team ever been blindsided by overcharges from one of those per-page billing virtual data rooms? It's 2025 and you'd think that scam would be extinct by now. If you're fed up with those outdated VDRs, check out Firm Room. There's no hidden fees, none of that 6-month minimum crap and then the price doubles after that. Absolutely no nonsense. Best part is you can check it out completely risk-free with a free 14-day trial, no credit card required. Visit firmroom.com and put it head-to-head with any VDR out there. Better tech for a better price. Here's to the deal.
Sounds like fun. But yeah, I think that being candid upfront, hey, these are how we operate to this level of standard in terms of how you're following the rules and billing practices. I was just thinking about like my personal expenses. That was my thing when I brought, speaking of the finance, when I brought CFO, he's like, no more personal expenses of the company. So
that's funny that you say that. There's not a single mom and pop business that I haven't had to spend the majority of my time discussing what adjusted EBITDA means. So whether it's their family's cars, whether it's their NBA basketball tickets, their condo in Miami, whatever it is, all of those, every deal we look at, there's all that stuff that's kind of buried in there. And it takes a little while to actually get in and figure out what's real and not real on the adjusted side. I can actually give you an example of a company that led to one of the more complicated situations where they had represented a lot of adjustments in their EBITDA. We gave them credit for those adjustments. I saw all the individual transactions come out, but they had actually never booked them to the P&L. It was all sitting on the balance sheet. Now, had we had a quality of earnings done, we would have easily have picked up on that. But I was at the time still wearing CFO hat, doing multiple different actions as leader of the organization. So but it was too small of a transaction I didn't want to justify paying 6 figures for quality of earnings on this little deal.
Exactly.
And then when we got done with it, 6 months later, finance is looking at the numbers. They're saying, hey, this is not at the run rate we thought we were buying. And so we start unpacking. We go, well, why are, the adjustments aren't trending the way they were. This piece is not showing up. And go, well, we start looking at where were those actually sitting. And the controller started working with the controller of the company. We looked at it and go, oh, you represented all of these adjustments in the P&L that were never in the P&L. And so because of that, even though we had all the detail, we'd seen all the transactions, it was sitting to the side, and we had to have a real conversation around escrow, around what does that mean, because you've kind of misstated the financials. So I think that's very often a complex situation in trying to give people appropriate credit. And they always want all the credit when they were the broker, but stepping back from it and saying, look, you don't get the credit for it if it's not real.
Yeah, let's break this down for the people maybe new to M&A. Is when you do sign your purchase agreement, you represent these facts. What do they call them? They call them your disclosures, basically.
Disclosure statement.
Right.
Yeah.
So you got your disclosure schedule, which is like, this is what you're confirming, this is what you're agreeing to. And then if some of those things turn out not to be true, essentially your recourse is either there's an escrow on the side, or there's like a reps and warranty policy, which you can put a claim against.
Yeah. So a couple pieces there, right? Reps and warranty and the size deals we're talking about, they're hard to come by, and the reps and warranty market as a whole is very difficult in the smaller deal space, and they're not underwriting policies anymore. So reps and warranty is really not even something we consider. And when Beacon actually recapped, we struggled to even pursue a reps and warranty policy in our space, and so they actually didn't do that. To your point, escrow is the other place. And so when we start negotiating a deal with a seller, we come to them with a term sheet. One of the terms that we're presenting is what are the escrow amounts that we're looking for. That escrow amount, I'm looking for a larger percentage of the sale proceeds to go into escrow based on how small the deal is, because you need a higher percentage, because the liability that we're exposed to as an acquirer is substantially higher, and there's potential for things that don't actually transpire the way we thought they would. And so we'll talk a little bit about the liabilities we have. But that is what we're focused on, is making sure that we have enough dollars in escrow. And when that starts to eat into a bigger chunk of the total purchase price, sellers get very concerned, because they think that they're getting all the money today. And it's like, if there's nothing found and everything you stated is factual and we have no issues down the road, every one of those dollars will come back to you. But every once in a while, you have to tap into the escrow.
What's the usual range of an escrow? Is it percentage typically?
Yeah, it's percentage for us. We're usually 15-20% of purchase price is what we're going to be looking for.
And then what's the hold period for?
In our space, it's going to be anywhere from 12 to 30 months.
Okay.
And what we usually see is kind of a stepped escrow, depending on how big the deal is. Particularly for larger deals, there can be a lot of money sitting on the sideline, and so we'll look at a release at 12 months and release at 24 months.
Regulatory burden, and then historical liabilities. What are your, like, how does that work in your industry? What are the things you uncover? How do you get around it?
Yeah, the complexity being in healthcare is that you don't just get to close a deal and set the liabilities to the side. So asset deal, stock deal, right? So fundamentally, if you acquire the stock, you acquire all the historical liabilities of the company. Asset deal, the intent of doing an asset deal is that we will be able to acquire the company without the liabilities. Doesn't work that way in healthcare. The government doesn't view it that way. States don't view it that way. You're able to set to the side a lot of the liability in an asset transaction. Not as favorable to the seller typically, and I'll give you a little more detail. We often have to get in a conversation with the seller around doing a 338H10 election and a step up in basis, because for them to treat an asset transaction the same way they would in a stock transaction, which is more favorable on the tax side for them, and I'm not a tax attorney, so don't owe me this, they're usually set up as an S corp, which allows us to engage in a 338H10 and step up their tax exposure to such that they are treated on a cap gains basis, where they have the same net proceeds as they would if it's a stock deal. So we usually have to walk people down the path of why we want to do an asset deal in states where we already exist. States where Beacon doesn't exist, we're actually using a stock deal because a lot of times that's how we're going to get a license in the state.
Yep.
We've actually entered many states where we've entered a couple states de novo without having any presence or any acquisition. And in doing so, it's taken up to 24 to 36 months just to get through the provider licensing process. Whereas if I can go acquire a company, that's going to give me the ability to actually get the license in that market at the time of close. If I do it under a stock transaction, I'm carrying a lot more of the liabilities. Do it under an asset transaction, I can set some of that to the side. But the reality is Department of Labor and or Medicaid billing, Medicaid fraud is a something that you don't just get to say, oh, well, that was on the previous owner's plate. So we spend a lot of time on the diligence trying to understand, one, where do they sit with their billing practices, and are there potentially issues that were uncovered? And if there are, we actually have a duty to report that information. And so that's where we have to come to the seller and say, hey, we saw such and such. I'll give you an example of that. We acquired a company. The state had changed its billing practices during COVID. The state was actually leveraging this provider to teach other providers in the state how to do the new billing practice because he was so advanced in the way he was doing the billing. After acquisition, the provider moved on, retired, and we used a third-party biller, an expert in the state. And when the third-party biller started reviewing the billing, realized that that person was not actually doing the additional step of reconciliation of billing that was required. In doing so, there was actually money owed back to the state. And so then you start getting into treble damages and some other major issues. And we had to bring in that third-party biller, meet with the seller, explain not just what is the liability that's owed back to the state, but now fundamentally we're running a much lower run rate business than we were expecting. And so we need to actually come in and we had to renegotiate purchase price a little bit tied to some of the escrow. So you have billing issues like that. You have the labor issues I alluded to earlier. It's overtime practices. We're providing 24 hours support care. A lot of times you see people are doing incorrect nighttime shifts, paying people whether or not someone's awake, on call. Those things can impact what rates of pay they receive tied to minimum wage. And that gets a little sticky for us. So we have to pay attention to labor practices. And then there's also the compliance issues and regulatory burden of how are they operating the programs such that if there had been multiple different compliance hits on the quality side, which there is a tremendous amount of oversight with state regulatory bodies assessing how operations work in each of our programs. Well, if somebody had been hit with multiple different incident reports that could have happened in the past, if I acquire that company, it's not like that was the previous owner and now Beacon's the new owner. It's, hey, we may absorb whatever those historical incidents are, and that's a part of our record now. And you may have gotten away with 10 incidents, but then the 11th one is going to be the one that triggers a provisional or conditional license that could really put us into a tailspin.
For anybody who's listening to this, you shouldn't be complaining about the deals you're working on. Sounds like way more.
There's complexity in our space, even though it can be very small deals. There's a lot of complexity and liability that we really have to dance around.
Yeah, I mean, this is serious liabilities. You gave examples of billing practices, the labor issues, the fact that this accountability transfers over, whether you're doing a stock or asset sale. You mentioned the strategy of leveraging stock for these, getting to the new market, getting into regulatory, sort of systems approvals faster. Versus asset. Do you ever get any pushback from the sell side in terms of how it impacts their taxes between asset and stock sale?
Yeah, that's where people start pushing back, saying, "Look, when they meet with their accountant, their feedback is, I'm going to make a lot more money if we do this on our stock deal." But the majority of companies that are organized appropriately are organized as S corps in our space, and so the ones that are organized as an S corp. That's where we have the ability to do the 338H10. And I try to take a very honest approach to negotiating deals with people. If I want to do the asset deal badly enough, I'm usually willing to pay the step up in basis with the 338H10 election such that we can treat it as an asset deal, but that the owner is going to be able to walk away with the same amount of money that they would have if it was an asset or a stock deal.
Got it. So not a huge difference.
No, not for them. But now that doesn't apply in every transaction, but so many of the companies that we're dealing with are S Corp, so we can do that.
Got it. So that's like a special election that allows them to not have the same treatment as like a C Corp.
I'd be scared to act like I'm a tax person, but I've spent enough time with CPAs and some of our lawyers to try to figure out how to dance around some of
More
that.
disclaimers in this podcast.
Right.
None of this is tax advice.
Absolutely not tax advice, but the 338H10, and then you also have the F reorg, right? So both of those are way over my head, but we have really good professional service partners who can figure that out for us.
You told me this phrase last time we talked. The more diligence you do, the less likely you're to close the deal. How do you balance that fine line?
Yeah, it is a complex place to be at times, leading transactions, because on the one hand, I'm negotiating with the seller and their deal team, and then on the other hand, I'm negotiating with my board and trying to convince them that we want to close a deal. And as we go down a number of different diligence activities when we do deals. Quality of earnings is one that is frankly a non-negotiable for me now, because after that one transaction, I said, I'm not going to get caught in a situation where we don't fully vet the financials thoroughly. And we have really good partners who do that work for us. The other is we have a legal team that we've worked with for a number of years, and they understand the healthcare laws we need to look at, compliance laws, as well as environmental real estate laws, because we own a lot of homes when we're running some of our programs. So I really lean into that team, but it's also to make sure that everything we bring back to the board is transparent. And we've really had to try to hone in on what are the things that are deal breakers and what are the things that are maybe indicative of the culture of the operations that potentially are not things that we can fix. I can fix poor HR payroll function. I can fix things that are, if the accounting is not done well. We can make sure we bill appropriately under the structure and the infrastructure we've built as an organization. But a company that fundamentally has bad quality culturally, that's tough to fix. And so we spent a lot of time trying to say, who is this organization really? Who are the people there? Who is it that's going to be running the business after the transaction? Are we displacing some functions that the owner may be engaged in? And if so, those are the problems. We can set that to the side. But every time we bring in the professional team, they really start unpacking the company, and we start looking at all of this stuff. We have to say what can be fixed, what can't be fixed, and walk a fine gray line as to what blows up a deal.
I was just thinking the whole picture about managing liability. That's a big factor in your deals. You got holdbacks is one tool. You've got getting a QofE done is the now added tool. I like this perspective of just being realistic and bucketing what you can fix and what you can't fix. I think that sort of lends to more like a go versus no-go decision. Mm-hmm. Are there any other ways or perspectives you have around managing liability?
Yeah, for us, it's spending a lot of time saying when we do what the Beacon platform is, when we overlay the Beacon platform, are we mitigating the historical practices of the organization? It's hard to set aside just from deal structure a lot of the liability. We can call out fundamental reps. We can actually, if we identify stuff early on, from a deal structure perspective, we can actually place some of those things into the purchase agreement as a special indemnity. So we've done some stuff like that where we find something and we say, look, yes, we'll agree to a 20% escrow, but this one specific subject area, that's particularly problematic. We're going to build that into a special indemnity that's not tied just to the standard escrow that we've built for the deal. So that's one way from a deal structuring perspective we can. But a lot of times it's just spending time figuring out who the people are that may be a liability.
Well, in that case, though, that means basically you're saying, hey, this is going to be separate from the current structure that falls in the holdback, and this means we can go sue you, basically.
Yeah. I mean, it could, or it will actually have a separate escrow tied to it. Oh. And so a lot of times we'll say, look, this liability burns off at a different pace than the general reps and warranties you may have, right? So that is something we try to identify. That early on. That also makes a big difference on if it's a broker-led deal or non-broker-led deal. So we're very different than a lot of the deals you'll see in the corporate space. And it's, as we've brought people into the umbrella of Beacon who have come from corp dev or M&A or private equity and seen bigger transactions, they're used to seeing, pretty sims with the sell side Q of E, with a term sheet that's very specific and outlined. Ours is brokers that maybe have put together a 2-page sim with all the detail that they have. Oh. And we're just trying to get it across the finish line. And broker-led deals are helpful for me because I can lean into a broker to, when we identify an issue, that broker can actually walk the seller through why that is impactful. So there's a trust element between the broker and the seller such that they can help mitigate the negotiating burden that I carry on certain elements that we find. On the flip side, we can find a lot of favorable deals using a search firm where we're reaching out to providers that meet the kind of qualifying elements that we're looking for in a transaction. But then that means I've met that seller. They weren't contemplating selling originally. And so now I'm needing to sell them on a transaction, but then I'm also almost acting like their broker. And I'm explaining why the liabilities or these issues could actually be deal breakers or what the financial exposure may be. And so that makes it a lot more complicated trying to manage those type of issues.
It does, but aren't you likely to get better terms?
Theoretically, you should get better terms, and we do. We usually will get a little better on the purchase multiple, but you see quite a few. I would say there's a higher fallout rate on those transactions. Usually, if a broker gets a deal to a letter of intent, we're closing 60, 70% of those deals, versus we can get to a letter of intent with a deal that we've sourced, and maybe we're closing 25% of those deals.
Wow. That's why you kind of made that emphasis when you told me about the deals you closed, because there's some real work on deals that you didn't close.
That's right.
Interesting.
Yeah. And it's been, and the amount of time that, I think it's the goal of anything where you have a pipeline, right? It could be a labor pipeline. It could be a referral pipeline. And for us, it's an M&A pipeline. How can I get them out of the funnel earlier? Because by the time I get them down to the late stages of the deal and I get to the point that I've spent all the money on the QOV, I've spent all the money with legal building a purchase agreement. And when those deals fall out, those are the ones that really hurt.
You know what I find interesting in this conversation is the emphasis you put on the whole risk and liability of these deals. Most of the corp dev people I talk to, it's, the legal guy's going to take care of all this. But part of me is like, I think you've kind of like been in the trenches and maybe singed your hands enough times that it's something that, I don't, unless it's just you with the finance background thinking about this, I don't know.
I think it's both the moral obligation of trying to figure it out for the company's benefit in the future. Because the last thing I want to do is you could take on a single transaction that could tank the company. And I think that is something that has happened in our space, in the home and community-based service space. There were hungry, larger entities that just played the roll-up game. And so we have fundamentally tried to take a very different perspective. We haven't closed a crazy number of deals. The 15, 16, that's not a lot of deals, but it's because we've been very thoughtful that we don't bring on the wrong asset and that it doesn't taint the whole ship such that we're going to sink it, because that has happened to a lot of big providers in our space. And that's why there's not a lot of scale providers in our space, because it's a very difficult market to scale. One thing I didn't unpack earlier is just that every state in Medicaid or in home community-based Medicaid services, completely different. The way they do reimbursement is different. The operations of programs are different. What it's called is different. So, because each state actually works with the federal government in setting up their waivers and dictating how they're going to deliver care in the state. And because of that, you can't just overlay the consistent playbook. We had a lot of fun with our board talking about what's our playbook. It's like, well, The playbook is what is required in the state. And then we can talk to you about how we do it. So we had to be real thoughtful about migrating from kind of the standards of what Beacon wants to be versus what the standards of the state require.
Yeah, that's a whole big nuance of, I can imagine that. Like, however, what we already talked to with just the nuances of the business and liabilities itself, and then adding that all these states operate completely different. And you need to understand that regulatory environment and figured it out.
Yep.
Sounds like a lot of fun. That's where we'll pause the conversation for now. We covered a lot of ground. And the next episode, we'll pick it up right where we left off and keep digging in. Thanks for listening. We'll see you in part 2.